Today's market moves weren't just about a rebound in equities. They reflected a shift in how investors are weighing geopolitical risk against inflation and policy expectations. U.S. stocks started the week on a strong footing. The Nasdaq led with gains just over 1%, followed closely by the S&P 500, while the Dow lagged slightly but still finished higher. At the same time, bond yields moved lower, with the 10-year Treasury pulling back toward the mid-4.3% range. That combination, rising equities and falling yields, set the tone for the session. In commodities, oil rebounded modestly, holding above the mid-90s, while gold was relatively flat and Bitcoin saw little movement. Volatility eased further, with the VIX slipping back below 20, suggesting a normalization in short-term hedging demand. But the more important story wasn't the price action itself, it was the shift underneath it. What changed today was how investors interpreted geopolitical risk. After last week's escalation around the Strait of Hormuz, markets had started to price in a more severe supply disruption scenario, one that could push oil significantly higher and reinforce a stagflationary environment. But over the past 24 hours, signals of a temporary pause in maritime tensions, along with partial normalization of tanker traffic, forced a reassessment. Not a resolution, but a shift from worst-case disruption to something more contained. And that distinction matters, because once that extreme risk premium started to unwind, it changed how capital began to reposition. We saw a clear rotation back into growth and cyclical sectors, especially technology and financials, while traditional defensives like utilities and consumer staples were sold. In simple terms, investors moved from protection back toward participation. Lower yields supported that shift as well, making long-duration assets like tech more attractive again. At the same time, financials catching a bid suggests something deeper. Markets are beginning to price in the possibility that, if stress reemerges, central banks may be forced to lean towards stability over strict inflation control. So this wasn't just a risk-on day. It was a recalibration of multiple narratives at once: geopolitics, rates, and policy response. But beneath that rotation, there are still signs of fragility. One risk that doesn't seem fully priced is the physical constraint in energy markets. Even if shipping lanes remain partially open, storage capacity across key production regions is reportedly tight. That creates the possibility of forced production shutdowns, not because of demand, but because of logistical bottlenecks. And that type of disruption behaves very differently. It's not immediately visible in prices, but if it materializes, it can extend supply shocks well beyond the geopolitical event itself. At the same time, concerns around the banking system haven't fully disappeared. Recent data on regional bank balance sheets suggests that underlying stress may still be building, even if it's not yet front and center in market pricing. So while markets are stabilizing on the surface, the foundation remains sensitive. Which brings us to the broader signal. What today's price action suggests is that markets are trying to balance two competing forces. On one side, easing geopolitical pressure and lower yields are supporting risk assets. On the other, persistent inflation dynamics, especially through energy, and potential financial system fragility are limiting how far that optimism can go. In other words, this doesn't yet look like a clean risk-on environment. It looks more like conditional stability. And the key question going forward is whether that stability can hold. One open debate right now is whether markets are underestimating how quickly energy dynamics could tighten again, especially if supply constraints shift from geopolitical to physical limitations. I'd be interested to hear how you see this. Is the recent easing in risk a sustainable shift, or just a temporary pause before volatility returns? Looking ahead, the next phase will likely be tested by a few critical developments. Updates on energy production and storage conditions in the Middle East will be key. At the same time, any new signals from central banks, especially around how they balance inflation versus financial stability, could reshape expectations quickly. And finally, ongoing data around bank balance sheets and credit conditions will be important in determining whether underlying stress is building or easing. The broader takeaway from today's market reaction is that investors may be stepping back from extreme risk scenarios, but they haven't fully regained conviction in a stable growth environment. Markets are stabilizing, but they're not yet comfortable, and that distinction matters. If you enjoy this kind, calm, structured breakdown of how markets are actually thinking, consider subscribing. I share regular briefings focused on the deeper forces shaping global markets. Thank you for spending a few minutes here today. I appreciate you being part of the channel.